With more than 6,000 small and micro-cap companies listed, if you're looking for the next Apple at the earliest stage, then Channel Check truly is the orchard. The listed companies support Channel Check, so it's free for you, the potential investor, to gain access to institutional quality research from FINRA licensed analysts, advanced market data, industry reports, news, and a growing catalog of videos and webcasts. Make sure to subscribe to our YouTube channel and register for Channel Check so you're always up to date on what's going on at the small and microcap data place. Welcome to the Transportation and Logistics Forum, a NobleCon online investor event presented by Channel Check and Noble Capital Markets. Noble is an SEC-registered, FINRA-licensed broker-dealer and the source of the equity research available on Channel Check. This presentation features EGLE Bulk Shipping, NASDAQ ticker symbol EGLE. Following a brief overview presentation from Director and CEO Gary Vogel, Noble Research Analyst Poe Fratt will moderate a Q&A session. With that, I am pleased to present Gary Vogel.
Good morning. This is Gary Vogel, CEO of EGLE Bulk Shipping. I appreciate the opportunity to speak to you today about EGLE Bulk Shipping and the dry bulk industry. I'm going to move forward in the presentation and talk about what differentiates EGLE Bulk. EGLE is a fully integrated ship owner operator, and we're engaged in global transportation of dry bulk commodities. One thing that makes us different is we're focused exclusively on the Supermax and Ultramax mid-size segment within dry bulk. We own 53 vessels, of which almost 90% of our fleet are fitted with exhaust gas cleaning systems or scrubbers. Also unique is we employ an active management approach to fleet trading, and we perform all management services in-house. We have an industry-leading corporate governance structure and a focus on ESG, and we have no related party business operational dealings with a majority independent board. We're headquartered in Stamford, Connecticut, with offices in Copenhagen and Singapore. EGLE really has transformed itself over the last 6 years during the cyclical uptrend. The Baltic Supermax Index hit an all-time low in February of 2016. And through that time, we've acquired 29 modern vessels and divested of 20 of our smaller, older, and less efficient ships. And again, we've also transformed our business into the active owner-operator model that I'll speak about a bit further. We've also worked hard on improving our balance sheet, and that culminated with a global refinancing just at the beginning of the fourth quarter. So in that global refinancing, as I mentioned, $400 million comprehensive refinancing, of which $300 million is a term loan and $100 is an undrawn RCF. In the last quarter, we generated $78 million of net income, which was the best quarterly result in the company's history. In fact, the third quarter was better than any annual result in the company's history. And we also announced and established a quarterly dividend based on minimum of 30% of net income. And that led to a payment of just over 30% or $2 per share, which was paid on November 24th. As I mentioned, EGLE is exclusively focused on the Supermax, Ultramax space. But what you can see here among the US listed dry bulk companies is we're the only company with a focus on just one asset class. And we think that's important. I keep using the term active owner operator. And because we deploy our fleet actively, having all our ships in one size class gives us operational efficiencies that you just don't have across other asset classes. You have a Cape-size vessel and a Supermax vessel open in the same port. You can't use one cargo for another and maximize efficiency. But all of our ships are between 52 and 64,000 deadweight, giving us much more optionality. This here is probably the most important slide when we talk about, when we talk about EGLE's differentiation and active management. If you look at the bottom strata, time charter out, that's the way most ships are basically employed within dry bulk shipping, in that they're leased out on a daily rate. And you can think of it in much like a car rental. The person who charters the vessel or rents a car, decides where it goes, pays for the fuel, and brings it back. While we do that, we prefer to live above that in voyage chartering, where EGLE gets paid a per ton basis to carry cargo. There's a lot of advantages to that. First of all, when we contract that way, we can show up with any of our 53 ships, but actually we can charter in any of the over 3,500 mid-sized geared vessels in the world, supplementing our fleet. And in that, moving up, we do vessel and cargo arbitrage. So we may have a cargo on the books and a ship for it, but we'll try and find a better ship that fits it or a better cargo for our ship, chartering in vessels. And then we use derivatives to hedge away market risk. Sometimes we'll charter in a ship, use a derivative to fix away the fixed period, and we create what we call asymmetric optionality on the backside. So this is all the methodology, but of course what's important isn't what we say that we do, but what the outcome is. And what you can see here is that over the last 5 years, really, since the first year in which when I arrived at EGLE and we built out the new business model, we've basically outperformed the index almost throughout, except in the last year when the market shot up dramatically. What you can see here is that we have reported over 32,000 net TCE, 75% covered as of the time of our last earnings call. So I can't update that as of this time. I will note that the market backed off to a level down to just over 24,000 and has now recovered to about 28,000. So directionally somewhat down from when we gave our guidance, or at least where we were covered for the fourth quarter, but still, directionally, those numbers would equate to the best quarter in EGLE's history. And of course, operational leverage, because our costs are fixed, we have extreme operational leverage to the upside. And last quarter was also our highest ever EBITDA, as that tracks TCE very closely. Another thing to talk about is ship values. As I mentioned, we've acquired 29 ships over the last 4+ years, including 9 ships just in the last 10, 11 months. And those ships, you can see that prices are up about 95% indicatively over the last 11 months this year. Pretty significant and obviously very meaningful when you're talking about NAV of a company based on market adjusted asset values. The BSI is on track to have its best year since 2008. You can see this annualized average rates. And we're very constructive on the market going forward, and I'll talk a little bit more about that in a few minutes. I also mentioned that EGLE's fleet is almost 90% fitted with exhaust gas cleaning systems or scrubbers. And this is important because those ships are able to burn heavy fuel, HFO, as opposed to very low sulfur fuel oil, and it scrubs the sulfur at the point of exhaust. And the benefit of that is the fuel that we're using on those ships is significantly less expensive. This chart shows the fuel spread between HSFO and VLSFO. And you can see it's been quite volatile. It dropped pretty significantly during COVID on the back of a drop of crude prices and also the lack of other demand for mid-distillates, particularly jet fuel. It's now risen to about $150 per metric ton. And to give you an idea, that equates $150 spread per metric ton equates to about $35 million of incremental revenue or fuel savings for EGLE on an annualized basis. The forward curves showing about 112 going forward, although we as a company are more bullish on fuel spreads than what the forward curves would indicate. Excuse me. This is the net fleet growth chart. Basically, the light gray are the deliveries coming into the market, and dark gray are ships being recycled or scrapped. And what you can see here is going forward that the expectation is quite positive for dry bulk, with net fleet growth this year at about 2.9%, and then about 2% next year and falling off significantly. One real positive here is that berth availability for 2023 is all but gone. So we think it's very much quite locked in already what we're seeing for 2023. There's also been a really limited amount of scrapping this year, and that can't continue forever as older ships need to dry dock every 2.5 years. So we're quite positive in terms of the supply side. I've been in dry bulk for 33 years. And, I tell people if I could only look at one thing to indicate dry bulk health going forward, it would be supply. And it's really at the lowest levels we've seen since 1996. Very, very positive. You can see here I think the main takeaway for this slide is that global GDP and dry bulk demand are inextricably linked. Global GDP is expected to reach 5.9% this year. That's not where dry bulk will be, but overall you can see directionally extremely positive. And that gives us, that's a positive for going forward, as well as we think that as we recover and come out of COVID and restocking and things like that, and stimulus is really positive for dry bulk. I think a really important part of the demand picture is also where EGLE derives its demand from. As I mentioned, our Supramax and Ultramax vessels, they're very versatile in that we carry major bulks and minor bulks. In fact, as you can see from the chart on the right, that we get about 2/3 of our demand come from minor bulks. And if you look at the current 2021, what you'll see is dry bulk overall growing at 4.1%, where it's being led by minor bulks at 5.1 and major bulks at 3.5. If we look at next year, we can see, although down significantly, minor bulks are leading at 2.3%, with major bulks at 1. But we don't carry much iron ore. Our focus on the major bulk side is definitely skewed towards grain and coal, which is leading the major bulk. So we feel quite good about where the demand is expected to come from next year. And again, this needs to be seen against the context of the lowest order book and muted supply coming into the market for next year as well. This is a graph which just illustrates the flexibility of the mid-size asset class. All the way to the right, the Cape-size vessels really are focused on iron ore, on coal, and to some extent bauxite. Moving to the left are Panamax and Kamsarmax vessels, which also carry grain. Our ships have cranes and grabs on board, meaning they can load and discharge at ports without infrastructure. And we carry all of the major bulk cargoes, but also the minor bulks as well. So it gives us much more diversity in terms of commodity, but also geography and the trading routes. There are many more of them, so we can triangulate, and our ships spend much less time empty going to pick up cargo than the larger vessels. This is a new slide in our investor presentation, and I think it's really interesting. What it illustrates is that this year, the BSI has averaged around $27,000 per day, and the Cape has been at 34. And a lot of times there are headlines about Capes running up to $35,000, $40,000, even more. But if you look at the averages, you'll see that when you net out for OPEX and G&A, and arguably OPEX on a Cape is larger, but we've just used the same number here, what you can see is the yield on a Supramax is significantly higher because the Cape vessel, a 5-year-old Cape, costs about 1.7 times as much. And I think if we look forward, it's really interesting to see that the forward freight agreement, the FFAs for next year, are trading with the BCI, the Cape index, at just $2,000 above the BSI, notwithstanding the fact that ships cost, as I mentioned, 1.7 times more. So this would indicate operating profits for Capes for 2022, slightly higher than Supramax, notwithstanding that price difference. And then when you factor in volatility, the risk-adjusted yield for Supramax, Ultramax really increases significantly. I think this is an important notation because, as I said, a lot of times Capes get the headlines because they race up. But if we look at the averages overall and we look at the volatility as well as the price differential, the Supramax, Ultramax are really, we think, a great place to be in terms of dry bulk and exposure to it going forward. I talked earlier about significant operational leverage, and I think this is also really important because it shows, the effectively on an illustrative basis, assuming $1,000, it shows on an illustrative basis based on our market outperformance on scrubber differentials, what our net income, what our EBITDA would be, assuming no hedges and things like that. And what you can see here is based on the current forward curve to the left, next year the output would be around $225 million of net income. Of course, real world is different in terms of, gives us the ability to try and maximize revenues and things like that. But illustratively, it shows that $1,000 increase in the BSI equates to about $17.5 million of incremental net income, or $1.36 per share. So with that, in the interest of time, I think I'll stop there and I'll turn it to Po and be happy to answer any questions. Thank you.
Great, thanks, Gary. Why don't we talk about the macro first, and then we'll talk about EGLE. Um, Love the new slide highlighting the outperformance, from a yield standpoint of the Supras and Ultras versus the Capes. You highlighted how the Ultras and Capes have outperformed, or I'm sorry, Ultras and Supras have outperformed relative to the Cape market. Is there anything that could change that looking into 2022, or do you think that 2022 will be sort of similar from a overall market standpoint?
Well, I mean, of course, the answer is yes, something could change. But if we look forward, right, expectation is that minor bulks are going to be leading dry bulk demand overall, and the weakest of the major bulks is iron ore, which is the largest cargo for Capes. So at the moment, based on all those things, I think that's why you see the forward freight agreements trading at just a $2,000 differential. But dry bulk, definitely there's changes and surprises out there that could happen. But at the moment, we feel like the Supermax Ultramax is in a really good spot given the demand dynamics that we see right now.
And when you talk about the surprise on the iron ore side, there's also been a surprise on the coal side. Coal's been a little bit stronger in 2021. What's your longer term view on coal?
Look, I think long-term view on coal is negative. I mean, given the focus on decarbonization. Having said that, for us, it's just one of many cargoes that we carry, and in fact, the majority of the coal we carry, although percentage-wise, it's meaningful. It's actually mostly short haul between Indonesia and China, Indonesia and India, which is where there's still coal-fired electric generation coming on stream. So long-term macro, we see it coming off, but actually next year coal is expected to grow by 1%, and we think the thermal coal is positive for the next few years.
And when we look at sort of 2022, Gary, some of the factors that we're sort of looking at is, seasonality, congestion, and, the firm container market. What's your view on those three areas as we look into 2022?
Yeah, I mean, no doubt we've been beneficiaries of some what we call spillover cargoes from the container market. I mean, the director of the port of LA Long Beach said they expect this to continue well into next year, and I think we've been benefiting somewhat from that. We also had significant congestion in China, which has really unwound quite a bit of it. So this is a dynamic market, but I think we've shown resilience as our market, notwithstanding that unwinding, has come back up and over $28,000. So dry bulk is always dynamic / volatile, but we think this is par for the course. And under all that, the fundamentals are really strong.
And when you look at the order book, you highlighted the order book is, very positive. It's one of the indicators that you look at for the health of the industry. Do you expect the order book to increase at some point in time, or what do you think will happen 2 to 3 years out?
We're in a really unique situation right now because, first of all, secondhand assets are simply better investments. I mean, you get a ship on the water and you get to put significant cash flow in the bank, as opposed to ordering a new building and not getting that ship for at least 2 years. So just from pure economics, that makes sense. But then you start to overlay uncertainty around future regulations and decarbonization. I mean, I can't imagine going out and ordering a ship today where that ship will only be 10 years old in 2035 with really no visibility on what the price of carbon will be and things like that. So aside from the economics, just having that, what I call the tail risk, is really quite extreme. So it'll be interesting because it'll really depend, of course, on demand and how strong this market gets. But I think ordering will remain muted unless we see a really extreme freight market in terms of dry bulk. As I said, it's a really unique time because we're overlaying very limited berth space, partly because there's been such ordering in other segments, particularly the container segment, which are typically larger and more complex ships. And then on top of the uncertainty around decarbonization. Never really seen a setup like this, in my 30 plus years in dry bulk, and it's exciting to see it start to develop.
Great. You talked about, the tail risk from a carbon emission standpoint of building something new. How do the carbon emission rules that are on the horizon, how do they impact the existing fleet? And then if you could talk about, how you're positioning EGLE to comply with those regulations.
Yeah, so the first one that coming in, 2023 is the EEXI, which will force less efficient ships to slow down. The good news for us, first of all, ships slowing down is positive for rates because it takes effective supply out of the market. So then the question is, where are you? Are your ships slowing down, or are other people's ships, relatively slowing down? And the good news for us is, that comprehensive fleet renewal that we've done over the last 5 years, buying 29 modern excuse me, efficient ships, selling 20 of our older, smaller, least efficient ships is really positive for us. We only have 2 ships left that are over 13 years old, and we've been clear that our intention is to sell those vessels prior to the next statutory dry dock, which is one's in mid-22 and one's in early 23. So EGLE is going to be a huge beneficiary of EEXI. And then comes CII. That's going to take more time and increase more stringency as we get into the latter part of the decade. But EEXI should be beneficial for dry bulk. And of course, as we go forward, price on carbon and things like that, less efficient ships are simply going to become more expensive and less competitive. And we think that will lead to them a 2/3 tier market and more accelerated scrapping.
So you do think some scrapping will happen even if rates stay relatively elevated?
It's of course it's a dynamic and in some ways a circular reference, right? So the higher the rates go, the more compelling it is to stay out there. The higher costs are for less efficient ships. The less efficient your vessel is, the less attractive it is to stay versus scrapping. So if we're in a very high environment, even those inefficient ships will stay. But as that market, as it becomes more expensive for those ships, it's more likely that you'll see them scrapping. I mean, ships can't stay out in the ocean environment forever. The average scrapping age is around 25 years for a mid-sized dry bulk ship. And we see that go a bit above, a couple of years above and a couple of years below, depending on market. But you don't see ships carrying on into their 30s in terms of age in the mid-sized dry bulk segment in general.
Okay, let's switch to EGLE, your favorite topic.
Absolutely.
When you look at 2021, as you alluded to, not only the years leading up to 2021, but 2021 was a pretty significant year from a capital structure standpoint. As you talked about, the refinancing, really positions you to have, to capture opportunities going forward. The fleet's expanded. Any thoughts on how the fleet will look in over the next couple of years and maybe 5 years out?
Sure. I mean, first of all, we feel really fortunate that we've done a lot of heavy lifting up to this. So, we didn't know when this market would really, take off, but I do believe that you need to invest in this business at the low part of the cycle. Nobody hits the bottom, but along the way, and those 29 ships were all acquired at levels well below where they're worth today. And we were able to grow our fleet by about 20% during that time. So we just don't feel a lot of pressure to go out and pay $27, $28 million for a ship that effectively we paid 16, 17 for just 10 months ago. So I'm not saying we're not looking at opportunities, but it has to be pretty compelling, and the forward rates would really need to be strong to support paying today's levels where you could, depreciate that asset from an investment standpoint down to, more long-term levels. So, I don't know what EGLE will look like, but really right now our focus is on operational, really excellence and making sure we're positioning ourselves to earn as much revenue as possible in what's a really robust market, for the benefit of the shareholders. I'd probably feel a little more pressure if our fleet had gotten 5 years older over the last 5 years. It stayed the same age. If our fleet had stayed the same in terms of size or gotten smaller, as I said, we've grown at 20% and the efficiency has gotten greater. So, we feel, really fortunate that, we were able to get a lot of, all of that done prior to the market taking off this year.
Yep, the efficiency's up and you know, you have a pretty majority of your fleet scrubbed. What's your assumption for fuel spreads looking into 22? It seems likely that they'll widen a little bit just based on, you know, recovering energy demand or, you know, fuel oil demand. Is that
Yeah, I mean,
something that,
right now they're at the highest level they've been since COVID hit, at around over 150, which is really great. And I think if we saw levels close to that, we would probably look to hedge some of it. We had a very significant hedge position prior to COVID, which was of course really beneficial when spreads collapsed. Having said that, for various reasons, the fuel spreads for next year are around 112 right now, and we just don't think that's compelling given where the spot spreads are. So we're not executing, locking in fuel spreads at 112. We're more bullish than that at the moment. But when we see levels that we think are interesting, we'll start to engage in that market again. We haven't hedged since prior to COVID, but as I said, those hedges were really beneficial for us. And the current environment is equates on an annualized basis. I mentioned it in my prepared remarks, around $35 million, and we're talking about an investment in total for us on the scrubber front of about 100 million. So pretty really robust cash flows at the moment.
and when you look at your chartering strategy, it's really set up, it seems like, to capture volatility, to, really add value even if rates are, on a relative basis, either high or low, but, you capture a lot in volatility. Is is your view still, even with rates high, that time charters are unattractive and will pretty much never be a part of your strategy?
No, absolutely not. So I don't think time charters are unattractive. I think time charters have certain attributes that make them, less attractive than derivatives, and there's some that are more interesting. But without getting too granular, when you relet a vessel for a year, it's not a year. It's probably about 9 to 12 months, and about means 15 days in shipping. So that means the charter can redeliver the ship between 8.5 and 12.5 months. That's a huge optional period that gets used against the owner. In a weak market, you get that ship back at 8.5 months, and in a strong market, you won't see the ship until 12.5 months or close to it, right? So we go in with eyes wide open because we can use derivatives and not give away that optionality. Having said that, derivatives, have capital requirements in terms of margins. They add some noise to the balance sheet. So we don't it's not one or the other, but we have our, like I said, eyes wide open, and we look at the value of one against the other. And those markets, although they're highly correlated, don't trade completely in tandem. So when the physical market is much above the derivative market, we're more inclined to relet a vessel. But again, we value that optional period that you're giving away when we do that. There's an old saying, right? If the only tool in your toolbox is a hammer, everything looks like a nail. So if you don't use derivatives and you only fix out your ships on time charter, then you're just a price taker, right? We look at the time charter out, we look at the derivatives, and we make a determination what we think the best way to lock in cash flows or hedge risk. I can tell you that, in the recent downturn, while we have a hedge position for next year, and I can't speak about specifics, with the market downturn, we bought back some of those hedges because we felt that it was overdone. So we unwound some hedges, and we started to put them back on as the forward market for next year went back up from a low of about 16,000, and now it's around 22. So there's value to be had from actively engaging in the volatility of the market, both the physical and the derivative. But we do have some charters through the better part of next year. We've talked about them on our last couple of earnings calls, charters in the upper 20,000s for next year, one on a Supermax, one on an Ultramax. And we'll continue to engage both using derivatives and using time charters. But the one thing, and then I'll stop because it's a long answer, the one thing about time charter out is we no longer have control of that asset when we charter it out, and we can't operate around it and engage in our active management. So we prefer to control the asset. So all things being equal, we prefer derivatives over chartering our ship, and giving it to someone else.
Yeah, I think over time, investors are appreciating the, hedge book and how it complements your operating fleet. When we look at the cargo market, Gary, have Has there been any changes over the last 6 months, or since the market's improved? And more specifically, are higher rates impacting the cargo market or pricing any cargoes out of the market?
Yeah, if I'll answer it in a second, but if I could just go back to your comment, because I think it's a good one that investors are appreciating it. I fully appreciate that without hedge accounting, that having derivatives adds some noise to the balance sheet, and so it's definitely not without needing explanation and looking at the queue and seeing those positions. But I think what investors appreciate is the net TCEs that Eagle's able to deliver. Right, TCEs very, very close, and sometimes more than fleets that have capes in them, which I mentioned are much more expensive vessels. So, at the end of the day, what we focus on is how do we deliver the highest TCE, the highest cash flows for our investors. And as I said, we need to explain some of the accounting aspects around the derivatives, but I think our investors appreciate that at the end of the day, it's about delivering, net income and cash to the balance sheet.
Yeah.
So now let me pivot to your question. The answer is there definitely are some changes given the high freight market, and some low value cargoes are more impacted. In general, freight is a small component relative to commodity price, but even more important relative to end use. And if you think about it, an extreme example would be silica sand used in the production of glass, right? It really doesn't matter how much it costs to move it. You're not going to not build glass windows for an office building because freight for moving that sand was higher, right? So there's a good example. So high price commodities have virtually no impact or have incredible elasticity. When you get into more base cargoes, then it's more impactful. But having said that, with infrastructure and stimulus, we're seeing robust cement movements now because people simply are willing to pay for moving cement because they need it, and there's a limited amount of production capacity. So we expect cement imports into the U.S. to grow significantly in 2022, which is a relatively low-cost commodity. So while it's impactful to the lower on a relative basis, as I said, dry bulk freight rates really don't compute very much in terms of finished goods.
And when you look at, your comment about secondhand assets being, attractive relative to new builds, can you just talk about it a little bit more? Is it all about opportunity costs and relative pricing, or what else are you looking at as far as just the way you look at, asset purchases?
Yeah, I mean, ships in many respects, they're like small businesses, right? And if you could tell me the future market, which effectively is future cash flow, you can, given what your cost of capital is, you can come up with an asset value. So it's all about what is future cash flow. When you order a ship, it's about future cash flow that starts 2 years out. So, that's why, resale vessel today is worth more than a new building delivering in 2 years, because you're able to capture a significant part of that and effectively, write down the asset purchase price with that operational, net income. So that's really the main driver when you look at a 5-year-old ship versus a new building on pure economic terms. Having said that, ever since I got to Eagle, I've said we are not going to be ordering ships because the world has enough dry bulk vessels. I think I've been quoted on that a lot of times. With today's rate environment, you could make the argument that we don't have too many dry bulk ships, and fair point. At the moment. Having said that, long term, there are going to be changes and decarbonization. We just don't think it's in our shareholders' interest for us to go out and order ships. And whether we have enough or not, as a ship owner, Eagle being a ship owner, right, the less new ships coming, that's directionally positive for rates. So, I said it earlier, future supply is always the thing to focus on. At the moment, it looks great, but we always keep an eye on it. And I don't see that changing. But as I said, we're always keeping an eye forward on what future supply in the order book looks like.
Understood. And if we switch over to other parts of the capital allocation, process, congratulations on paying the first of dividend, a significant $2 dividend. what should, it is based on a percentage of net income. Should investors expect some fluctuations and variability in the dividend? And then is there, if so, is there any way to smooth it?
Yes, so first of all, as you said, it's a minimum percentage of net income. So if you just look at it from a standpoint of 30%, there's no question there'll be variability. And we think that's appropriate in a business that's a cyclical, volatile business, notwithstanding that we're really constructive on rates going forward. And you know, the TCE guidance that where we were 75% covered at higher rate than last quarter indicates, you know, that next quarter should be significant as well. In terms of smoothing it out, the excuse me, the dividend last quarter was slightly above 30%. So that, at least, you know, actions speak louder than words, shows that the board is not married to specifically just 30%. It doesn't mean that there will be a smoothing out, but 30% was chosen after a lot of discussion and analysis. And it was done in such a way to give us the ability to use capital for various things. But if we don't see opportunities in other things like asset acquisitions or share buyback or convert buyback or things like that, then by all means, the board has the ability to simply declare a dividend higher than 30%.
Great. You brought up, you know, buybacks of not only the convert, but also stock. Where do those fit in your capital allocation strategy?
So, you know, it's something that we're charged with coming in every day and asking ourselves, what's the best use of capital for our shareholders? And clearly, you know, fully aware of the calculus for a share buyback and NAV. You know, I think the outcome of share buybacks in dry bulk or shipping in general is quite mixed in terms of the benefits for shareholders, and whether increasing a dividend is better or putting cash on the balance sheet for future investments, things like that. You know, it's a discussion that we have every day, but it's definitely one of the tools in the toolbox, and that's why the board announced an authorization for up to 50 million for that very reason. So that's something that we are analyzing and will continue to do so as we go forward.
Yeah, I guess that, you know, the advantage of buying the convert back is you do, you know, eliminate that future issuance too, from the standpoint of, you know, the potential dilution that you might see from, you know, shares as the convert debt is converted into equity.
Absolutely. Yeah.
When you look at your strategic goals for 2022, can you highlight some of the sort of the top three, if you would? And then maybe, you know, from a standpoint of what do you think could be the biggest surprise in 2022?
Yeah, so the main focus is execution now. As I said, you know, we feel that we have a fleet. We've been able to demonstrate an ability to outperform dynamically, you know, manage the risk. And it's really about delivering the highest return, highest TCE, and highest value for our shareholders. And whether that's returned in dividends, cash on the balance sheet, paying down debt, you know, all of it accrues to the benefit of our shareholders. So, you know, I think that one thing, I think there's so much discussion around capital allocation, and it's a really important topic. But far more important in my mind than capital allocation is the business, right? Are you in the right segment? Are you maximizing the revenue? Are you running an efficient operation? Because ultimately, if we can deliver through our business model an extra 30, 40, 50 million dollars of EBITDA, you know, that we can use for any of those capital allocation things, that's to me far more important than whether we decide to pay 30 or 35%. Because if we pay 30 and not 35%, the other 5% stays on the balance sheet for the benefit of the shareholder. It doesn't go away. So, you know, to me, again, that's to me the most important thing is execution. You know, ultimately, you know, what happens in 2022, I'm sure there'll be things that we don't expect right now, but really it's about, you know, putting the pedal down and you know, the 53 assets that we have, you know, are really to engage them in the market the best way possible. So that's really how we see it. You know, what could surprise? You know, I think a robust recovery from COVID, where this world gets in, you know, a synchronous growth, you know, together, I think could be really amazing. Because the thing about dry bulk supply is, it's really fixed for a long time, right? And no matter what happens, we know where the supply is coming. And the real variable on supply is only scrapping, and it's been quite low. So if we get growth to the upside, I think you really could see rate development that we haven't seen in quite some time. So that would be amazing. But having said that, the market's at $28,000 right now, and that's pretty amazing too.
Yep. What more could you wish for? I mean, if the surprise is positive in 2022, it should be a really good year. With that, Gary, I really appreciate your time. Compliment you on your performance at EGLE over the last, several years. You've been one of the most consistent performers, and having capital on the balance sheet should not scare investors because of how well you've allocated that capital over the last several years. So, here's to looking for good news in 2022. Thank you so much for your time.
Thank you, Paul. I appreciate it. Happy holidays.
Thank you for joining us for this NobleCon online investor event presentation, brought to you by ChannelCheck and Noble Capital Markets. Visit our YouTube channel for more video content, including interviews, virtual roadshows, and conference presentation replays. New content is added regularly, so subscribe below to stay up to date. Visit channelcheck.com or click the link in the description to access equity research, news, and advanced market data on this and the 6,000 other small and microcap companies listed.